We always start with market structure because structure tells us the direction we want to trade. Our goal is simple: trade in alignment with the dominant trend, not against it. From the left side of the chart, we can clearly see that the market is bearish. Price is creating lower highs and lower lows, which confirms a downtrend. As trend traders, this immediately tells us that we should only look for sell opportunities, not buys. As price continues to move, we then see a clear break of structure to the downside. This break of structure is important because it confirms that sellers are still in control. It is not just a random move, but a sign that bearish momentum remains strong. After this break of structure, price does not continue straight down. Instead, the market pulls back upward into a key area. This area is what we identify as an order block. An order block represents the last strong move where institutions placed significant orders. The most reliable order blocks are created after a clear break of structure and align with the higher time frame trend. This is exactly why this order block is valid and worth paying attention to. Now, the reason we are interested in taking a trade from this order block is not just the zone itself. What really strengthens this setup is the inducement that was created before price returned to the order block. The market intentionally formed inducement to trap early sellers and weak hands. Once that inducement was swept, liquidity was taken and the market was ready for the real move. At the same time, if we look lower on the chart, we can clearly see sell-side liquidity resting at the lows. This sell-side liquidity represents unfilled orders and stop losses that the market naturally wants to target. Liquidity is the fuel of the market, and price is always drawn toward it. Now that the price has returned into the order block, inducement has already been cleared, and sell-side liquidity is below, we know the conditions are aligned. This is where patience matters. We do not enter blindly. We wait for confirmation on lower time frames to show that sellers are stepping back in. Once confirmation appears, that is where we execute our sell entry. Our stop loss is placed above the order block with enough distance to avoid being taken out by a simple wick or liquidity grab. This placement protects us from manipulation while keeping our risk controlled. Our target is the sell-side liquidity at the lows because that is where the market is most likely to deliver price. This gives us a logical and high probability take profit level. Finally, risk management is non-negotiable. We always risk a small fixed percentage per trade and never over-leverage. Consistency comes from discipline, not from forcing trades. If you want to understand these setups deeply and trade like smart money, make sure you follow and watch the next video because it builds directly on this concept.